Typically, when inflation is too high, the Federal Reserve raises rates and inflation should come back down. The logic is if the Fed raises rates and makes it more expensive to borrow money, people and businesses will spend less money, and that lack of demand will make the price of things come back down. But at the end of the day, all the Fed can really do is control monetary policy. And right now, there's a geopolitical conflict causing an energy shock, and monetary policy can't create energy. And energy is a base cost on everything you see. It's in the price of your food, your car, your home. So right now, we're seeing a different type of inflation. A type of inflation that has the Fed in a position where for the last few months, they're kind of just holding steady and not making any moves. But the crazy thing is, this is not the first time there's been an oil crisis in Iran, which has caused a massive inflation risk in the US. The last time the US dealt with this kind of inflation, the Fed responded very differently. In the late 1970s, inflation was running out of control, driven largely by, funny enough, oil shocks, a result of the Iranian Revolution, where the Shah of Iran was replaced by a more Islamic regime, and high levels of social unrest severely damaged the Iranian oil industry, leading to a large loss of output and a massive rise in prices. And the Federal Reserve, led by Paul Volcker, made a decision to aggressively raise interest rates to bring inflation down. And they didn't raise rates by just a little bit. They raised it by extreme levels. The federal funds rate went above 15% and even briefly hit around 20%. This made borrowing extremely expensive. Mortgage rates went above 18%, businesses could not get financing, and spending collapsed. And the economy was pushed into a deep recession. Unemployment rose a lot, but that was kind of the trade-off. Volcker's strategy was essentially to crush demand hard enough that prices had no choice but to come down, even with high energy costs, and eventually it worked. Inflation fell from about 14% back down to around 2%, but it came at a massive cost to the economy in the short term. So now that you know the history, we can look at what's happening today, because in a way it's very similar, and it gives some truth to the quote that history doesn't repeat itself, but it does rhyme. Because today, we're seeing another energy shock involving a geopolitical conflict, again involving Iran. And one of the most important pieces of this is something called the Strait of Hormuz, which is basically one of the most critical shipping routes in the world for oil. Roughly 20% of the global oil supply moves through that one narrow passage. And when conflict escalates in that region, whether it's attacks on infrastructure or threats to shut down shipping routes or actual disruptions to supply, oil prices react almost immediately because the market starts pricing in the risk that less energy is going to be available, and we're already seeing that play out. Oil prices have been rising sharply and supply has been disrupted across the region. This feeds directly into higher energy costs across the entire economy. And because energy isn't just one category, it's an input in almost everything: transportation, manufacturing, food production, even electricity. So when energy prices go up, everything else starts getting more expensive as well. And that's what makes this type of inflation different, because it's not being driven by people spending too much money, it's being driven by supply constraints, and that leads into a much bigger problem. The problem is the Federal Reserve only has one real tool, and that's interest rates. And interest rates work by slowing down demand. If borrowing gets more expensive, people spend less, businesses invest less, and prices come down. And that works when inflation is caused by too much demand, like we saw coming out of COVID. But what's happening right now is different. This is being driven by supply, specifically energy. And you can't fix a supply problem by reducing demand. Raising interest rates doesn't create more oil, it doesn't reopen shipping routes, it doesn't build power plants faster. All it really does is slow down the economy. So the Fed is stuck in a position where they can either raise rates and risk pushing the economy into a recession just to reduce demand, or they can hold rates steady and let inflation stay elevated. And neither option is good, because this type of inflation isn't something monetary policy can easily control. It's coming from physical constraints in the real world, not just financial conditions. And that's what makes the situation much more difficult than we've seen over the past years. Now, earlier, if you remember, we talked about how Paul Volcker actually did fix inflation by raising rates, and he was going through an energy crisis too. So if he was able to do it, why can't we just do that again? Well, the reality is there's a deep cost to what he did the Fed is trying to avoid. Because yes, raising rates high enough, especially to double digits, it did work. But it came at the cost of a deep recession. Unemployment was spiking above 10%, businesses were failing, and millions of people were losing their jobs. And the only reason it's viewed as the right decision today is because we're looking at it decades later. At the time, it was incredibly unpopular and politically painful. No administration wants to be in charge when there's a massive recession. And even though the Fed is technically separate from the main branch of government, they're still not immune to political pressure. And we even saw this recently when Trump was aggressively calling for Powell to cut interest rates. And Paul Volcker went through that same political pressure when he kept rates high. People were calling him crazy. They were saying he's destroying the economy. Some people wanted him in jail. And that's the situation the Fed is facing again. Because if they decide to aggressively raise rates to try and crush this kind of inflation, they risk triggering a serious downturn in the economy. But if they don't raise rates and inflation stays elevated because of energy and supply constraints, then you risk something else, which is high inflation becoming expected in the system. And you get into a situation where people start expecting higher prices and businesses constantly prematurely raise prices because of expected inflation pressure. That makes controlling inflation so much harder down the line. So from the Fed's perspective, there really isn't a clean solution. It's a trade-off between short-term pain through a recession or long-term pain through persistent inflation. And on top of that, there's the political reality. No one wants to be responsible for pushing the economy into a recession, even if it might be necessary. And government debt is so much higher today than it ever was in the past. In the 80s, we had around $900 billion in debt and a debt to GDP ratio of 50%. Now we have $38 trillion in debt and a debt to GDP ratio of 120%. So the government is in a sense dependent on those cheap rates to function. And what all of this is doing to the Fed is keeping them in a state of hesitation, slower decisions, and a system that's trying to manage a problem it doesn't fully control.